Good evening, everyone. How are you all? कैसे हैं सब? Now, it's so good to see that today I have received so many of greets just before the start of the session. Tanu, Sushil, Saloni, Pratiksha, really nice. And I need a few more greets to, just charge myself up for the session. So just waiting for some more greets. Then we can proceed with our today's topic and finish off this chapter. Audit strategy, planning, and program. So, oh, wow, really nice. Okay. So, we had divided this chapter into 3 parts, right? One was audit planning, right? Second, audit program, and third, audit materiality. So, audit planning, audit program, these were those topics where you could apply your layman knowledge as well to understand the topics. But today's topic, audit materiality, right? It is a bit technical and we need to understand it with quite our patience. Okay, so be with me for the whole session. During the whole session, we'll be taking up different terms, right? Exploring them up and we'll complete this concept of audit materiality, right? With all those explanations. Okay, so as we start with today's topic, audit materiality, I have some terms to be discussed with you. These terms we are going to find place in our today's write-up. So it's better to go through these terms, understand the meaning of these terms. These are some technical terms and you need to understand these terms because while writing your answers in the exam, these are the terms which you have to refer to, you have to use in your answers to improve the strength of your writing, improve the strength of your answer. As you are sitting in the exam center as an examinee and an answer is expected of you, a professional institute will always expect technical and professional answers from their examinees. So professional answers, how can we frame professional answers? Professional answers are always framed by using technical and professional jargon vocabulary. So during the study of this whole subject, I will request you people that you maintain a list, a register, or wherever you want to note the audit vocabulary. You have read about professional judgment, professional skepticism, audit evidence, right? Now we are going to do materiality, material items. So this vocabulary, you need to at least have a look at it or go through before appearing for your exam. So that instead, along with writing your general vocab or general English which you write, these terms should form a part of your answer wherever necessary. They should not be overused, but wherever necessary, these terms should form a part of your answer. And we can use these terms only after we understand their meaning in a legible manner, concise manner. Okay? So here we go. Today's our first term is, since our topic is materiality, we need to know what are material items. Okay. Okay. So our first term is material items. What does it say? The items. So here items refers to the elements of our financial statements. The elements of our financial statement. We know when we talk about this is a materialistic world, materialistic feeling, materialistic aspirations, that is a general term, that layman term, being materialistic and material items. In audit, materiality carries a different meaning. You can more or less relate it to significance, importance. Okay. So the items here refers to the elements of financial statements, like your profit and loss elements, your balance sheet elements, your account balances, the knowledge of which might influence the decisions of the users of the financial statements. So we all know who are the users of the financial statements: the owner, the government, right? The stakeholders. These are all the users of the financial statements who form an opinion, who take a decision on the basis of these financial statements. For example, for the listed companies which are listed on the stock exchanges, an investor plans to buy or trade in the shares of those companies which are profitable. Have you ever heard an investor who wants to invest, barring some exceptional cases, an investor who wants to invest in the shares of a company which is losing its price, which is on a downfall, right? So here, what was the item? The profit making by the companies, the knowledge of which I knew that the profit of this company is declining year after year. It has influenced my decision as a user of that financial statement, that I became a user when I read their financial statements to come to a decision whether I want to purchase the shares of this company as an investment or not. So the items, in my example, it is the profit, the knowledge of which it has influenced my decision as a user of those financial statements that whether I want to purchase the shares of this company or not. Similarly, the government may find the profit or the tax paid by the company material. The stakeholders, or you can say the shareholders, will see dividend. It might be a material item for them. Or what is the amount of remuneration being taken by the board of directors? It is a material item for them. So material items are those elements of financial statements which might influence the decision of any user. Next is a very important term, misstatement. So you can, this is co-joined word statement, which is misstatement. They can understand a wrong statement, right? So what is a misstatement? In an audit, in the terms of auditing, misstatement is a difference. I'll be taking up the same example which we have been taken since the beginning of this chapter. That was the example of a hotel, right? And Jay was a permanent article with me, and we had taken Sneha and Charu or Tanu sometimes along with. So I'll take that example only, wherever necessary. So misstatement is a difference between, difference between what? Actual financial statement items prepared by the client. So client furnishes you the financial statements. So this is my balance sheet, this is my profit and loss, this is my trial balance, these are my books. And those required by applicable accounting standards. So someone asked me in the previous lecture, sir, what and how is it applicable in DS, AS, IFRS? When I told that you will read about it, there are level 1, level 2, level 3 enterprises. There is an applicability criteria. So as per that applicability criteria, different enterprises have to adhere to different standards. Some have to follow accounting standards, some have to mandatory follow Ind AS, and wherever IFRS is applicable, they have to follow IFRS. So whatever standards are applicable to them, accounting standards, right? As per those applicable accounting standards, what would have been the value of that item or the presentation of that item, and how it is not only about value, it is about presentation as well. and how has the client valued and prepared it. So misstatement, understood, it is the difference between actual financial statement items as given or prepared by the client and those required by the standards. Misstatements, including omissions, are considered to be material. So what could be misstatement? A figure which has been valued wrongly or presented wrongly. And misstatements include omissions as well. You all understand error of omission and error of commission, right? From there you can relate. Misstatements including omissions. So misstatements include statements which have not been presented or valued properly, right? And there could be some omissions as well. They forgot to include the salary of one of the managers. This is an omission. The profits are inflated because one of the expense was not booked. He was being paid in cash. Take the example of a small entity where the manager is being paid the salary in cash and they forgot to debit that particular expense, subject to the tallying of cash at the year end. So what is it? This is an omission. We all have read about errors of omission and errors of commission. So they become misstatements only. Error of omission is a misstatement only when it is going to actually affect the decision of the user. It becomes material and it becomes a material misstatement. We'll come to what is a material misstatement. First of all, we have to understand what is misstatement. So misstatements, including omissions, are considered to be material. Here it is. We have understood what is misstatement. Misstatement is when there is a difference between the actual financial statement items as prepared by the client and those required by applicable accounting standards. Now, what is a material misstatement? A misstatement, when it becomes material, it is a material misstatement. When does a misstatement become material? It tells us it is considered to be material if one misstatement or many misstatements individually or in the aggregate. So one individual misstatement or some total accumulation of many misstatements could reasonably be expected. Reasonably means logically. Reasonably means logically, right? Could reasonably be expected to influence the economic decisions of users taken on the basis of financial statements. So it is same. What have we done? We have combined material items and misstatement. So it becomes a material misstatement. We read about what are material items. Then we read what is a misstatement. Then a misstatement, if it is something which can be ignored or something which is not that material, right? Which is not that significant. Whenever I talk about material, it has different meanings. From audit perspective, you have to take it as significant for time being. So what are material items? What is a misstatement? Material items are those items or elements of financial statements, right? Those items or elements of financial statements which might affect the decision of the user. Misstatement is the difference between actual figure and as required by the standards. So when this misstatement, right, includes material items, when this misstatement includes material items, right, it becomes material misstatement. This misstatement includes material items, it becomes material misstatement. For example, let us take an example of the hotel, right? So they said that material items, right? For example, in our example of the hotel, one of the food items in the restaurant, let us take the example of potatoes, right? So they have purchased a whole lot of vegetables. So there was a shortfall of half kg potatoes. They might have purchased 50 or 100 kg potatoes, right? And there was a shortfall of half kg potato. They don't know where it is. They don't know where it is. Half kg potato. So they need to understand that whether the shortage of half kg potatoes, whether it has been pilfered with or it got lost while bringing to the hotel, whether it is material or not. Whether it is material from the point of view as a user or not. The half kg potato you lost, the shares of the hotel are going to decline. Half kg potato and the shares of the company will fall in value? Never. So this was not material at all, right? It might turn into a misstatement that the value of potatoes, if not booked as a loss, how was it adjusted? But instead, you see, we ordered a host of vegetables, a lot of vegetables, and the order of potatoes has not reached. But in the books, it seems its cost has been debited. Its cost has been debited, and it is seen from the books that it was received duly. But you couldn't find any acknowledgement of receipt of the potatoes in the hotel. Now this is material. This is important. This is significant. There could be other cases like this as well, where some items were purchased and they were not okay, right? So this is material, and yes, this needs to be taken care of. The difference between misstatement and material misstatement. So Shivam is asking me, sir, day before yesterday, you take an example of a glass which was broken by J. Is a material mistake or not? Oh no, glass broken by J is not that material unless and until it was a vintage glass. It was a glass placed by them in their wall of fame, or it was something which was of much value for the hotel. So it is not that material. Don't blame J for that. Material means, can we say important or that sort of something? Yes, J. For time being, you have to. We'll come to different variations of materiality in auditing. But for time being, yes. As a layman, you can understand material means something significant in auditing. As far as the financial statements are concerned, and which may impact the decision of the users. Okay. Next, uncorrected misstatement. So we have misstatement, then material misstatement, then uncorrected misstatement. Uncorrected. So you were in school and your teacher made you write something from the board, and you write it on your notebook, take it to your teacher, and your teacher says, see, there are some spelling mistakes and all, and you need to improve them. Take your notebook home. Tomorrow you should bring it all corrected. Next day you get up, you forget, and you come to the school as it is, go to the school, and your teacher asks you, did you correct your mistakes? And you show her your copy. No. So that was an uncorrected, right? Uncorrected work. In the same manner, when an auditor is auditing the books of any entity, he finds some misstatements. What were misstatements? difference between actual data and data that should be there as per the standards. He finds 1, 2, 3 or n number of misstatements which he has accumulated during the audit. Accumulated means writing it down, or just it has been brought to his knowledge, or he has compiled them all, 5, 6, 7 kind of errors, mistakes, whatsoever, flaws, omissions. So as many misstatements as an auditor has accumulated during the audit which have not been corrected, not been taken care of by the people who have compiled the accounts. These are known as uncorrected misstatements. Okay? See, we have to take baby steps. Material items, misstatement, material misstatement, and uncorrected misstatement. So you are just building the foundation of these terms. As and when you progress with the newer chapters of this subject, chapter 3, 4, you will find these terms again in chapter 5 of fraud, chapter 6 of automated environment. You will find these terms again. You will be strengthening the conceptual knowledge of these terms as and when you proceed ahead with the subject. Okay? So misstatements that the auditor has accumulated during the audit that have not been corrected. So they are uncorrected misstatements. Now we come to finally the definition of materiality. What is materiality in auditing? It says, materiality is a concept or convention within auditing and accounting relating to the, see what we have been assuming till now, taken till now, importance or significance of an amount. Amount in the financial statements or any transaction. Whether there is something fishy with the amount or something fishy with the transaction, any error, any omission, or something which might result into a fraud at a later stage. Transaction amount means an amount that has been present in the financial statements. Transaction means any transaction. For example, the manager gave the contract of potatoes to his uncle, who is a vegetable vendor, at a higher rate than the prevailing rate. So this is a material transaction. When you have other options of purchasing the potatoes of the same quality from the market at a lower rate, why are you purchasing from this particular vendor? So this is a material transaction, right? Or discrepancy, error. Materiality forms a basis for determination of the audit scope and levels of testing the transactions by the auditor. So what is material in the financial statements or in the circumstances for time being? The auditor has to define particular level of materiality. After it is defined by the auditor, it is a big enterprise having turnover into crores. So if there is an expense of 1 lakh in lakhs, this is something which is material for the auditor. But an expense or an income in hundreds, it is immaterial for the auditor. This is just an example, a practical example. Like the example I gave you of half kg potatoes and a whole lot of order of potatoes. So auditor has to define the materiality level, and this materiality level will definitely decide how much work the auditor has to do about the scope of his audit. How much work will he have to do, and at what levels and how many levels testing he has to carry out. First step, second step, third step. How much testing of the controls he has to carry out. Okay. Okay, yeah, I know you receive all, got the notification today of the exams. Khushi, I cannot understand your question. Can you please repeat it in a different or rephrase it, please? I cannot understand your question. Let's move ahead. Material items, misstatement, uncorrected misstatement, and materiality. Now, here we come. Material misstatement, uncorrected misstatement. Now, what is this term? Performance materiality. So, read with me, okay? Whenever there is such definition which seems to be too long, like you can see it as a para, okay? Whenever you get to read such definitions or learn them, always break them into parts, as I am going to do and understand. Okay, so be with me. Performance materiality means, okay, here we start, the amount or amounts, that means it could be a single amount or various different amounts, right, set by the auditor. First part is the amount or amounts set by the auditor, right? Then at less than materiality, okay, so it is an amount which has been set by the auditor. So it is amount or amounts set by the auditor. Auditor has decided that this is the relevant amount or amounts less than materiality. So if I decided in an enterprise or the hotel, right, I decided this hotel has revenue in crores. So any amount of expense or income less than 10,000 is immaterial for me, right? Of low relevance for me. I have set my materiality amount to 10,000. Take this example. So I have set my materiality amount at 10,000. So what is performance materiality? Amount or amount set by the auditor at less than materiality. So less than materiality means less than 10,000. It could be 8,000, it could be 7,000, it could be 9,500. Be with me on the example. For the financial statements as a whole, okay, for the financial statements as a whole, to reduce to an appropriately low level. To reduce to an appropriately low level. For example, what could we think that this is the lowest level that could be there of misstatements? We want to reduce that particular level to below that particular lower level. For example, there was 10,000, right? We set up a materiality level before that, which we have already designated that this is our materiality level. And the auditor has set up an amount less than that level. Okay, so that the probability that the aggregate of uncorrected and undetected misstatement exceeds materiality for the financial statements as a whole. So the auditor is following a conservative approach. He says that I have set the materiality amount to 10,000. I'll set my performance. So as far as 10,000 is concerned, we are going to get much lower level of uncorrected and undetected misstatements, because above that level we are going to test check and almost every transaction and amount. So there would be very low probability. There could be a low probability that some of the transactions or some of the misstatements remain uncorrected or undetected by us as an auditor. The auditor, if he finds a misstatement, he accumulates. These are called as uncorrected misstatements, right? And if he fails to detect somehow, any misstatements, those are known as undetected misstatements. Okay. So he's following a more conservative approach. He sets up a materiality level less than the normal materiality, so that this particular probability of not being able to detect material misstatements or the uncorrected misstatements could remain false much lower than the previous level. So that particular level below materiality is known as performance materiality. Calculating materiality level is the professional judgment. We'll do it. We'll do it. This is it over here in our part. If applicable, performance materiality also refers to the amounts set by the auditor at less than material level for particular classes of transactions, account balances, or disclosures. So you need to understand two different parts, right? The first part is setting up materiality for financial statements as a whole. Here we have done it. Financial statements as a whole. Or setting up materiality levels for not the financial statements only, but different classes of transactions. For example, all the selling expenses or all the direct expenses. So this is a different class of transaction. Or we could set up materiality level for account balances. For example, the balances of debtors or the creditors, or the disclosures we want in the balance sheet. The disclosures which should be there in the financial statements. So auditor may define materiality, right? Auditor may define materiality with respect to the financial statements on a whole for every kind of item, every account, every transaction. Or he could define materiality level for classes of different materiality levels for different classes of transaction, for different account balances or different disclosures. Okay. For example, I have told my staff that any income or expense below 10,000 in this particular hotel is not that important for us. It is immaterial because the turnover runs into crores, the expenses are also into crores. So 10,000 is the materiality level. Jay says, sir, do we really need to set up materiality level to 10,000? Why should we leave the items before 10,000? I tell him, Jay, it is a materiality level, right? Items below 10,000 are not going to affect the decision of the users because they are not going to impact the operations of the enterprise in any manner. Quite negligible or very low amounts they are. But Jay, being the hardcore article he says, no, sir, let us check each and every item. I said, okay, Jay, let us come to performance materiality. So I have set up the amount at 10,000, right? You take up the amount of 8,000. Jay is really happy because Jay knows that at 10,000, there could have been a probability that some of the errors or omissions could have remained undetected by the engagement team. Now at 8,000 materiality level, we will be checking each and every item, each and every accounting entry, each and every element of the financial statements, expenses, incomes, greater than equal to 8,000 from in the financial statements, so that the probability of not being able to detect those errors falls even below the previous level. Okay, this was performance materiality for the financial statements as a whole. Now I tell Jay, as far as debtors are concerned, please don't take external confirmations or balance certificate for any debtor below 20,000 rupees. Okay. So for the financial statements as a whole, whatever be the account balance, whatever be the transaction, whatever be the disclosure, I have set up a materiality amount of 10,000. Right? Now, when it comes to the account balances, I've told Jay that don't take external confirmations from any debtor which has amount outstanding less than 20,000. So this is the materiality level I have attached to an account balance. Okay. So this is how for the financial statements as a whole, or with respect to any transaction, particular class of transactions, account balances or disclosures. Anita, Vandana, is it clear now? Please let me know. The materiality and the concept of performance materiality. Please let me know. Otherwise, I'll take up another example. So we move ahead with the term benchmark. Benchmark is something that serves as a standard by which others may be measured or judged. You all know the concept of percentiles, right? In many exams, or the newly introduced concept of CGPA in your board exams, 10th board exams. So percentiles, board exams, targets, these are all examples of benchmarks. Something which serves as a standard around which others may be measured or judged. We'll take the examples of, we'll take the example of benchmarks in topics to come. Okay, Vandana. Thank you. You understood. Really nice. Now the next term is, okay, benchmark. Benchmark serves as a standard. For example, the J in the class, okay, it's a board, it's an exam in the school, and a person secures 90 out of 100. So he has set up a benchmark for everyone. If anyone could have scored marks more than 70. Okay. Or another example, in the market, in the industry or hotel industry, right? In the hotel industry, which is our example, a hotel, right? A hotel which was not affected to a great extent during the COVID period. So we have set up a benchmark that a hotel which was not affected much during the COVID period, or let us take the example of a restaurant. Let us not take hotel. Let us take the example of restaurant where they could deliver food via Zomato. Dining in was not allowed. Dining is not allowed. Carry away and home deliveries were allowed. So there is a group of restaurants, eating points in your city, and you want to know which eating point or restaurant could survive during the COVID lockdown. So what would you consider? You will consider some parameter. Let us consider the number of parameter, a number of orders, or turnover of the restaurants as the parameter. Okay. So these standards, any restaurant which could bring to the table at least one order or 3 orders per day, that restaurant was doing good. So what have I set up as the benchmark? I've set up as the benchmark that any restaurant which was servicing at least 3 home delivery or takeaway orders a day, or more than 3, was doing good. So all the restaurants which were not having or delivering at least 3 orders, 1 order a day, 2 orders a day, will say they were not doing good. So we have set up a benchmark of 3 orders. So standard, 3 orders. So 3 orders have served as a standard by which the performance of other restaurants could be measured or judged. This is benchmark. Okay, now what is financial reporting framework? Yes, Rakesh, Sensex is a benchmark, exactly. No, Sharon, that was my example. It could be different in different manners. I have taken the example of hotel where the figures are into crores. So figures in hundreds or thousands might not matter that much, and that too depends upon the case specifically. That was my fictional example. It is not always necessary that items less than 10,000 are not material. If there is a person, proprietor, whose revenue and expenses are in lakhs, so figure up to 1,000 rupees are very much important. Less than 500, you might take it. You can set up the materiality level at 500 rupees. If a person whose accounts you are auditing has his receipts and expenses in lakhs, for him or her, 10,000 is much of a material item. So there you cannot set up the materiality level up to rupees 10,000. Okay, I hope, Sharon, that is completely clear to you. What is financial reporting framework? The financial reporting framework is a set of criteria for financial reporting meets accounting standards. For example, your Companies Act lays down the format of disclosure of items in the statement of affairs and statement of profit and loss as per the applicable law. So it has given us a framework for financial reporting to report our financial statements. Okay, so this is financial reporting framework. These criteria are the basis for defining the measurement, recognition, presentation, and disclosure of all material items in a financial statement. Okay, so financial reporting framework might tell us you have to present items less than this particular amount in the financial statements. You have to present them specifically. We'll take example. We'll take example of this. Okay, as per Companies Act, we'll take example. Right? So financial reporting framework, Companies Act gives us a framework, which is a set of criteria for financial reporting. We have to present our financial statements in that particular criteria to meet the accounting standards. Other examples of financial reporting framework, you prepare the statements of a bank as per the Banking Regulation Act. Electricity companies, insurance companies, they have laid down their standards of formats of financial statements. An example of financial reporting framework. So let us take an example of financial reporting framework materiality levels. Yes, Charu, I'll definitely take it up at the end of the session. Okay. See, these are the examples of where financial reporting framework sets up the materiality level. Yes, Jay, you can say in layman language level. You can, that is a layman language level. So there are some statutory examples where there are statutory requirements of disclosures where they say this particular disclosure is completely material irrespective of the value of amount. For example, see the first example. As per Companies Act, a company should disclose by way of notes in additional information regarding any item of income or expenditure which exceeds 1% of the revenue from operations. So whatever trade the company is into, whatever receipts, operating receipts, you all might have done the cash flow statement, operating, financial and investing receipts and expenses. So whatever is the revenue from operations, calculate 1% of that, or a flat amount, rupees 1 lakh, whichever is higher. Okay. So what does the Companies Act say, financial reporting framework for the companies? It says you take up the financial statements of any company. Let us assume its operating revenue is rupees 1 crore. Okay. Or it is rupees 1 crore. Right. So 1% of revenue from operations is 1 lakh, or there is a flat figure 1 lakh, whichever they are equal. Materiality level for that company is decided as 1 lakh. Let us assume the turnover operating receipts of the company are 50 lakhs. So 1% of 50 lakhs, 50,000. Sorry, 50. Okay, yes, 50,000. So one limit we have got of 50,000. Another is a flat limit of 1 lakh. It says whichever is higher. So in this particular case, any income or expense which is more than 1 lakh, because 1% is 50,000, the flat limit is 1 lakh, we have to choose whichever is higher. That would be our materiality level as per the financial reporting framework. As per the financial reporting framework, in our case, it is the Companies Act. It says that any item of income or expenditure which exceeds 1% of the revenue from operations or 1 lakh, whichever is higher. In my example, 50 lakhs is the operating revenue. I calculated 1% of it, that came to be 50,000. I compared it with the other limit 1 lakh, and it says whichever is higher. So 50,000 or 1 lakh, which is higher? 1 lakh. So any of my income or expense which is lower than 1 lakh, I can club it. Right? I can club it. But more than 1 lakh, I have to bifurcate it, show it separately in my financial statements. It cannot be clubbed under any head. For example, my company's turnover is rupees 2 crores. For 2 crores, 1% is, what is 1% for 2 crores? 2 lakhs. What is the standard? 1 lakh. Whichever is higher. What is higher now? Not the flat limit, but the percentage. I calculated 2 lakhs. Now, any item of income or expenditure which exceeds rupees 2 lakhs has to be disclosed separately in my financial statements. Below that level of materiality of 2 lakh, I can club them under any head, a common head. Okay, so here it says you can also refer to the general instructions. In those instructions, it has been mentioned in the Companies Act. So I hope this particular example, this is a statutory example. I've taken the example of a financial reporting framework. Okay, see the next example, same Companies Act. A company should disclose in notes to accounts. We all understand what is notes to accounts. Shares in the company held by each shareholder holding more than 5% shares, specifying the number of shares held. So any shareholder in any company who is holding more than 5% shares of that particular company, right? His shareholding, his or her shareholding has to be disclosed separately into the notes to accounts with name. This particular person holds this much percentage of shares, which is this number of shares in our company. So in the notes to accounts, which are annexed to the balance sheet, this particular disclosure has to be there. Okay. So these are the examples of materiality, which has the auditor need not apply his judgment over here because it has already been given in the law, the financial reporting framework. He has to just comply with this particular requirement. And the law demands in the case of expenses or income, two limits, 1% of the operating revenue or rupees 1 lakh, whichever is higher. That is my materiality level in the case of a company for the financial statements as a whole. And for a group of, we said, class of transactions, account balances, disclosure. So here is this disclosure. In this, any person holding more than 5% shares in the company, his name has to be disclosed along with his shareholding separately in the notes to accounts. So this was an example of materiality set by financial reporting framework. Okay? Any doubts till now? So we proceed further with why is materiality such a significant concept? Yes, Charu. When if you are doing your articleship or when you'll start your articleship while doing tax audits, you'll get to know company audits that you have to mention related party transactions in the reports. What are the related party transactions? So that a fair view of that particular transaction could be taken care of. So related party transactions, yes, you have to disclose them irrespective of amount. Any queries or doubts, you can let me know so that we can proceed further. Okay. So meanwhile, let's proceed further with the significance of materiality. So just a simple reading, we all have understood till now. Materiality is an important consideration for the auditor, how to evaluate whether the financial statements reflect a true and fair view or not. We all understand what is a true and fair view. Okay, so the concept of materiality is applied by the auditor, both in planning and performing the audit. So when I told Jay that Jay 10,000 is my materiality level in this case, so that was during planning. And when Jay applied his audit procedures with either 10,000 or 8,000 as the material amount, so it was while performing the audit. So concept of materiality is applied both at the planning stage and further at the performance time. And in evaluating the effect of identified misstatements on the audit. So I and Jay have found some misstatements. We have identified those misstatements. What is their effect on our audit? So we might increase our audit procedures, right? So identified misstatements and of uncorrected misstatements. What could be the uncorrected misstatements? Last year we told the hotel, don't value your toiletries like this, or you are not presenting the stock of the bar properly in the financial statements. Please do it properly. Same year, the same problem is being carried forward by them. Same problem is being repeated by. From the previous year to this year, it is an uncorrected misstatement. Or there could be misstatements in the current year as well, which we asked them to correct, but they haven't corrected it yet. Okay. So misstatements which we have identified and misstatements which are still there, found by us, but have not been corrected by them. What would be their effect on our audit report? On our opinion? What opinion are we going to give? We might have given a clean opinion if they have corrected their misstatements, but they haven't corrected it. So it is going to affect our opinion as the auditor. The auditor should consider materiality and its relationship with audit risk while conducting an audit. What is audit risk? You will understand it in your chapter 4, risk assessment and internal control. Audit risk has many components. So audit risk is the risk of not finding a misstatement during the audit. This is audit risk. For time being, just understand it has many components. It has almost 3 components, the audit risk, right? So you'll understand it in your chapter 4. I'll not trouble you much over here. Just a layman understanding that an auditor might not be able to detect a misstatement during the audit. It depends upon 3 to 4 factors. So audit risk for time being is that way. Sonu Kumar Singh, as far as financial reporting framework is concerned, where there they have given the limits, you have to follow those limits. In all other cases, it depends upon the professional judgment of the auditor, based upon his skills, his studies, his expertise, his experience. Okay? When planning the audit, the auditor considers what would make the financial information materially misstated. So what would be his consideration? Whether this particular transaction or amount or group balance is materially misstated or not, only when he defines the materiality level. The auditor's preliminary assessment means before starting the audit, of materiality related to specific account balances, like I told you about debtors, creditors, fixed assets, classes of transactions, like I told you about selling expenses, direct expenses, helps the auditor decide such questions as to what items to examine and whether to use specific procedures. For example, I tell Jay and Charu were with me during the audit. So Jay is with me and I ask Charu, I tell Charu, I have set up the materiality level to this for the stock in the bar. Okay. Take up this questionnaire. I have designed this questionnaire keeping the materiality aspect in mind. Okay. And just fill up this questionnaire by making inquiries of the bar staff. Okay. So I set up materiality level as per the prices of various beverages in the bar. I have set up my materiality level. I've grouped those beverages into 3 slabs: less than 1,000, less than 10,000, less than 1,000, 1,000 to 10,000, 10,000 to 1 lakh. So I tell Charu, if there is some problem or you find something absurd in the less than 1,000 category, so just make sure it is not that important for us. But if you find anything absurd in the valuation in the category from 1,000 to 10,000 value or 10,000 to 1 lakh value priced beverages, make sure you fill up this questionnaire accordingly so that I may check it again. Okay. So this is how setting up materiality has helped me design my further specific audit procedures. Materiality enables the auditor to select audit procedures that nation can be expected to support the audit opinion at an acceptably low degree of audit risk. So audit risk, some misstatements could not be identified or identified misstatements could not be taken care of. Low degree means the audit risk is low. Low means you are able to identify almost all the misstatements that could be there. Acceptably low degree of audit risk. Acceptably low degree means the degree of audit risk that is acceptable by all. This is but obvious. This is going to be there, inherent. So in a financial statement of 1,000 transactions, if you could skip to check 2 or 3 transactions, this is normal. So acceptably low degree of audit risk means that your audit risk is as per the acceptable level. So I may use a combination of different procedures as well when I set up materiality, so that my audit risk is as low as possible and accepted by all. The auditor's assessment of materiality and audit risk may be different at the time of initially planning of the audit as against the time of evaluating the results of audit procedures. So sometimes Jay might have found that even in the 8,000 to 10,000 value category, there were many misstatements. Jay comes to me, sir, you were telling me set the materiality level to 10,000. Materiality level is still 10,000, but I have set up performance materiality by 8,000. Okay. So in the 8,000 to 10,000 class as well, slab as well, I have found many misstatements. Oh, really, Jay? That's really good. So what were your audit procedures? Let me evaluate them. And I check it and I find that yes, there is audit risk if I set the materiality level to 10,000. Let us decrease the materiality level. So there is a revision in the materiality level or the amount. This is how setting up materiality and relating it with audit risk has helped me in changing or revising my audit plan or procedures than the initial one. Okay, so this is where materiality is important. So we have some requirements, like which standards we have done financial reporting framework. We took the example of Companies Act. Now these are the 2 standards on auditing. Whatever we are doing on about audit materiality in this chapter, this is your SA 320 only. SA 320, standard on auditing 320, materiality in planning and performing an audit. Whatever topics we are taking up, covering in this chapter, they are from SA 320. Okay. So what is the object of this essay? What is this essay based upon? What does this essay enshrine upon? What does it contain? It contains about the aspect of materiality. So what does this essay deal with? It deals with auditor's responsibility, because standards on auditing, they are not standards on accounting. Standards on auditing are meant for the auditor, a person who is performing the audit, planning the audit, doing the audit, giving his audit report, the auditor. So he has to apply those standards. The client has to do nothing with the standards on auditing. They have to comply with the standards of accounting because they are doing the accounting. Audit is our perspective. So it will deal obviously it will deal with the auditor's responsibility to apply the concept of materiality in planning and performing an audit of financial statements. So this essay helps an auditor to describe about materiality, how he can apply materiality while planning and performing the audit. It requires of the auditor. Now it deals with the auditor's responsibility. Now what does it require of the auditor? What does it ask the auditor to do? It requires that auditors should consider materiality and its relationship with his audit risk while conducting an audit. If the audit risk is high, his materiality levels should be strong. If audit risk is low, his materiality level could be a bit higher. Okay, so SA 320, auditor's responsibility about the concept to apply the concept of materiality, and auditor should consider relationship of materiality and audit risk. Now there is another essay which talks about materiality, that is SA 450. Evaluation of misstatements identified during the audit. So what does this essay say? It actually explains how materiality is applied in evaluating the effect of identified misstatements on the audit. So we have identified some misstatements. How are those misstatements affecting my audit? So when Jay found many misstatements between the transaction ranges of 8,000 to 10,000 in the financial statements, it affected my audit. And I revised my plan. So Materiality helped me revise my plan to know about the effect of identified misstatements on my audit and of uncorrected misstatements on the financial statements. An example of uncorrected misstatement. You might have been doing final accounts and there were some adjustments of closing stock, overvaluation of closing stock, undervaluation of closing stock, right? So whenever you were doing final accounts question, in the adjustment entries, the opening stock has been overvalued by 10%. So while preparing our accounts, if we do not correct it, the overvaluation, the undervaluation, right? It will become an uncorrected misstatement. We tell the management, please value your stock accordingly. Eliminate the overvaluation or the undervaluation. If the department, the management does not pay a heed to this, this becomes an uncorrected misstatement because I have identified this misstatement. I've asked them to correct it, but they haven't corrected it. Right? They haven't corrected it. So if they haven't corrected it, it becomes uncorrected. And how is it going to affect my statements? My profit would be affected with the valuation of opening stock. So this particular essay, you have to tells us how materiality has to be applied while evaluating the effect of misstatements identified during the audit. So Abhijit asked me, so do we have to read auditing pronouncements? Yes, you do, dear. You do. Almost all the auditing pronouncements, many of the auditing pronouncements has been covered in your syllabus in auditing book in a liquid language, but still it is always better that you go through those auditing pronouncements. It is for your knowledge and you will find something really good and explanatory. So as see, you have done, you are going to complete essay 320 with me today. Okay. So essay 300 was your audit planning. So 320 you will be completing today. So after completing it with me, you can always, anytime, you can go through essay 320 from your auditing pronouncements. You will find everything similar, just 2 or 3 examples over there differently. So you must read it, the auditing pronouncements. Okay, let's move ahead. So we have the financial reporting framework. We already discussed what is financial reporting framework. Now, what does the first point say? The first point says financial reporting frameworks often discuss the concept of materiality in the context of the preparation and presentation. So while preparing the financial statements and presenting them in a particular format, we saw how Companies Act was telling us how to prepare and present the financial statements, what disclosures were required. They set up the materiality amounts. Such a discussion, if present in the applicable financial reporting framework, applicable means whatever FRF, financial reporting framework, is applicable to the entity. For a bank, Banking Act; for insurance, Insurance Act; for a company, Companies Act, right? So that is one applicable financial reporting framework. Provides a frame of reference to the auditor in determining materiality for the audit. For example, Companies Act has helped me as an auditor. It has already set up the materiality amount for the financial statements as a whole. When it said that you have the materiality level is 1% of the operating revenue or rupees 1 lakh, whichever is higher. So in the case of companies, I'm relieved that whatever be it, a small company or large company, 1% or 1 lakh, whichever is higher. Okay. No, Charu, your essays have been referred to everywhere wherever they are applicable. If we had taken up the concept of materiality, essay 320 says, and whatever topics are covered in your study module, they are from the essay only. You'll find it completely similar to your standards on auditing. Do one thing. When we complete the materiality concept today, okay, just open your book of auditing announcements, check for essay 320 and compare it with the study module. You'll find that almost everything is there in the module, and that too presented very in a simple language. You'll find the difference. There is not much difference. Okay. So it says when financial reporting framework discusses the concept of materiality. What does the second point say? The second point say if the applicable financial reporting framework does not include a discussion of the concept of materiality, what do you do in that case? So the characteristics referred below provide the auditor with such a frame of reference, some general characteristics, where the financial reporting framework is not telling us about materiality, has not set up any materiality amounts. In that case, some general knowledge. And what is the general knowledge? The following 3 points. What does the first point say? Subpoint. Misstatements are material. Misstatements are material if expected to influence the economic decisions of the users taken on the basis of financial statement. So we have already read it. What are material misstatements? So any misstatement which might affect the decision of the user is a material misstatement, and the auditor has to take care of it. Okay. Second point. Judgments about materiality are affected by the size or nature of a misstatement. So here the auditor's judgment, right? What are the circumstances? What is the size or nature of a particular misstatement, or a combination of both? Whether the value is material or immaterial, to what class of transaction it relates to. Okay, so here professional judgment you have to apply, and an auditor can apply professional judgment. An auditor can apply professional judgment depending upon the circumstances. Size or nature of misstatement. Size, remember my example of the hotel restaurant, half kg potato or a complete order of 50 kg potatoes. So the financial reporting framework will not tell if there is a shortage of half kg potato. No, it is my professional judgment. Size or nature of the misstatement. Half kg potato is nothing to do with the working of the hotel. But if it is a whole order of potatoes was missing, not physically received, but in books it has been received. The vendor has been paid. The manager's uncle, he has been paid, but he haven't received the potatoes. There is no physical evidence. Someone says kha gaye. Kha gaye, but there has to be some physical receipt, acknowledgement. Their potatoes were received on this day, as entered into the books of accounts. So that is, as per my judgment, material. Judgments about matters that are material are based on a consideration of the common financial information needs of users as a group. For example, if I consider the financial statements of a listed company, I know profits, the investors are a group of users. They are very much affected by the profits, right? If anything which can affect the profits majorly, that would be a cause of concern for me. That would be a material item for me, whether it has been provided in the financial reporting framework or not. Okay. Okay, Shivam, you can find the latest modules and the pronouncements with all the amendments on the ICAI website. You can download it anytime from there. This statutory examples we covered already, right? Okay, so let us complete this subtopic and then we'll take a break. The professional judgment which I have been talking about. The auditor's determination of materiality is a matter of professional judgment and is affected by the auditor's perception. What does the auditor perceive, see, assume? His expertise of the financial information needs of users of the financial statement. So, if the financial reporting framework tells us about the concept of materiality, auditor will have to comply with that. In case the financial reporting framework doesn't discuss the concept of materiality, auditor has to see these three common points, right? And as far as his professional judgment is concerned, what should he assume for the users of financial statements? So in that case, while applying materiality as a matter of professional judgment, it is reasonable for the auditor to assume that auditor can assume that users have these 4 points about users. Auditor should not be concerned about each and everything. Oh, this blame would be upon me later on. This particular blame would be on me later upon. No, he can always assume some basic facts and considerations to be true as far as users are concerned. That users at least know this much about the entity. Why should I need to include it in my audit? If the ICAI has given you the date sheet, they expect of you that you come prepared for the audit exam on when it is held. It is scheduled and not for the FM and ECO exam. So you cannot blame, we came prepared for the FM and ECO exam. How are you taking audits exam? It was scheduled. In the same manner, some facts with respect to users' knowledge can be assumed by the auditor. He need not take extra pain of that. What are those facts? What are those assumptions? Auditor can reasonably assume that users have a reasonable knowledge of the business and economic activities of the company and normal accounting. And they can study the financial statements with a reasonable diligence. Diligence means care, precaution, rationality, samajdari. Okay, he may assume that the users understand that the financial statements are prepared, presented, and audited to levels of materiality. That materiality has been taken care of. The users can recognize the uncertainties inherent in the measurement of amounts based on the use of estimates, judgment, and consideration of future events. So when you consider future events, you make provisions. They are accounting estimates, right? You consider future events apply your judgment on those future events, and come up with an accounting estimate that yes, we'll make a provision of 10% of from doubtful debts, 15%, 20%, 25%, whatever be your accounting estimate. So the auditor can assume that the users can understand the uncertainty. The doubtful debts could be only 5%. If you have set up the provision at 10%, the doubtful debts could raise up to 20%. But it should not be the case that you have set up the estimate at 10% provision and doubtful debts are somewhere around 50%. What kind of uncertainty was this which you could not smell? So minor variation in the uncertainty is inherent limitations. So the users understand this particular fact. And the users can make reasonable economic decisions on the basis of information in the financial statement. So somewhere an investor comes and finds that this particular CA audited the financials of this company. Hey, you audited this particular company. In the auditing statement, it shows a profit. I invested in this company and I lost my money. Hello. I assume that as a user, you can make reasonable economic decision on the basis of the information. Where it is written that a company who has made profit in the previous year is going to make profit in the next year again. It might run into losses owing to the circumstances. It is not guaranteed. You have to see the trend and everything while analyzing the profits of that company. And as a user, you have to do that. My work is limited to auditing. So these are the assumptions of an auditor, which is expected by him of the users while he determines materiality for his audit. Okay. So our next topic would be planning while planning the audit. Okay. While planning the audit materiality. So we take a break for 10 minutes, right? Be here within after 10 minutes and we'll finish this topic and we'll practice a case study today as well. The case study questions which you get in your exam. Okay, a case study is there and then a series of questions based upon that case study. You have to analyze the case study, apply the concepts, auditing concepts which you have read, and then answer those particular questions. So we'll also practice a case study based upon this chapter. I prepared a case study for you. Okay, so let's finish this chapter and then practice that case study. We'll be here after 10 minutes. Okay, we are back after a short break. So, understood the concept of materiality, some terms, financial reporting frameworks. Now, let us move ahead with the auditor's work while planning the audit. Okay, and the benchmarks. So, the auditor should determine materiality and performance materiality when planning the audit. So there are some general considerations which an auditor needs to keep in mind. They are listed over here. The auditor needs to consider the materiality for the financial statements as a whole. We talked about two materialities, right? One was for the financial statements as a whole, as I took in my example of any amount of revenue or expense less than, more than or equal to rupees 10,000, and materiality at the level of transactions or account balances or disclosures. So the example of materiality at the level of disclosures was as given by the FRF in the case of companies, financial reporting framework. You have to disclose about the shareholders holding more than 5% of the shares. So, or for the financial statements as a whole, or for a particular class of transactions, account balances, or disclosures. So, the auditor has to carry out a preliminary identification of significant components and material classes of transactions, account balances, and disclosures which he plans to examine. For example, the auditor finds that the company is incurring a lot of bad debts. So he'll be concerned about the debtors. And specifically, he'll apply his audit procedures with respect to the debtors' specific audit procedures. So particular account balances, right? Material classes of transactions. He feels that as compared to sales, the selling expenses have increased a lot when compared with the previous year figures. When compared with the previous year figures, there is not much increase in the turnover of the company. But the selling expenses have increased. So this is a particular class of transactions. So auditor has to consider materiality for the financial statements as a whole and specific materiality for different classes of transactions, account balances, and disclosures as well. So for this, he needs to make a preliminary assessment. Okay. Sometimes all the situations cannot be the same. What is material in one situation may be immaterial in another situation. For example, here is the example. Rupees 5,000 may be material for a small entity, a small client. For example, a client who has his turnover or her turnover in lakhs. So an amount of 5,000 may be material for him. But a client who has his turnover, his financial figures running into crores, the expenses, the receipts, for him 1 lakh may not be that material. Situations change. Small client and a bigger client. What is material for a small client, 5,000, is highly material for another client, for him, for which rupees 1 lakh is also not material. So as per the situation, as per the nature and size of the business, materiality tends to change, and this depends upon the professional judgment and preliminary identification by the auditor. Okay? If in specific circumstances there is one or more particular classes of transactions, account balances, or disclosures for which misstatements of lesser amounts than materiality for the financial statements as a whole could reasonably be expected to influence the economic decision of the users, the auditor shall determine the materiality levels or levels to be applied to those particular classes of transactions. Understand this point. With J, I set up the materiality level for whole financial statements at 10,000 in my example, which I have taken since beginning. For the whole set of financial statements, be it debtors, be it selling expenses, be it any kind of expense, be it any kind of account balance, I have set up my materiality level at 10,000. J comes to me and he says, sir, there is a big blunder in the debtors. We should set up a materiality level lower to what we have said for the financial statements as a whole for this particular account balance, debtors. I said, Jay, why are you so much concerned about debtors? What is the big deal? Sir, I have gone through their books, right? And what I feel is the accounting entries, I can find a lot of, I have seen and I can find a lot of further misstatements. So I said, okay, Jay, I give you a free hand. For the financial statements as a whole, we have set up rupees 10,000 to be the material amount. In the case of debtors, we can set up a lower amount. So with respect to particular transactions or account balances, like debtors, Jay said, sir, I'll take it as 5,000. It is completely fine. Because the circumstances, the facts of the case, they have forced me to take up a materiality level, what I have defined for the whole statements, a materiality level lower to that. For a particular transaction, class of transactions, account balances, or disclosures. Jay tells me, sir, you were telling me selling expenses have increased too much as compared to sales from the last year. Let us set the amount of selling expenses materiality to 7,500. Now, for the financial statements as a whole, I have set up the materiality amount to 10,000. But in the case of debtors, we have set it to 5,000, particular account balances. And in the case of a particular class of transactions, selling expenses, we set it at 7,500. So you need to analyze the situation and the need of the situation where you might have to lower your materiality level than what you have set for the financial statements as a whole. When it comes to particular class of transactions, account balances, or disclosures. This is what point 3 says. Okay, very important. While judging materiality, the significance of an item has to be viewed from different perspectives. Perspective means the way you perceive things. Nazariya. Materiality of an item may be judged by considering the impact on the profit and loss. How is this item going to affect profit and loss, balance sheet, or income and expenditure head, and its comparison with the corresponding figure for the previous year, like selling expenses in my case, sales in my case. So while judging materiality, we have to take care of different perspectives. Comparative figures, effect on profit and loss, effect of presentation in the balance sheet, right? So this is all what should be there in the mind of the auditor. He should be considering it while determining materiality and performance materiality. So we have done this. In planning the audit, the auditor makes judgments about the size of misstatement that would be considered material. How do these judgments help us? We can determine the nature, timing, and extent of our risk assessment procedures. nature, what procedure we need, when do we need to apply these procedures, and to what extent, how much these procedures need to be applied to check out our risk, assess the risk. Identifying and assessing the risk of material misstatement and the nature, timing, and extent of our audit procedures further depending upon this assessment. This we did in audit planning, and yes, materiality helps us in planning this as well. So next case is today the materiality level is 5,000. Oh, is it materiality level or the weather forecast is taking an example of? No. It is nothing like hit and trial. Let us take materiality level at this. Let us take materiality level that, depending upon weather. If it is sunny, I'll take the materiality level at this level. If it is raining, I'll take the materiality level up to this amount. No. When we talk about professional judgment, it is not based upon hit and trial. It is based upon your studies, your skills, your expertise, and your experience. Right? So professional judgment should be based upon certain facts and figures. And those facts here is what we talked about benchmarks in the beginning of our session. So it says a percentage is often applied to a chosen benchmark as a starting point in determining the materiality for the financial statements as a whole. Now we'll divide it into two parts. First of all, be with me. You are also auditor. I am also the auditor. You are my training. Okay. So we are setting up materiality at two levels. First level is for the financial statements as a whole. And the second level is for particular classes of transactions, account balances, and disclosures. We are opening up the financial statements. First of all, at a major level, macro level, where set up a materiality level applies to every item in the financial statements. Now, when we open up the financial statements, we found different classes of transactions, different account balances, and different disclosures. So we might set up the same materiality level for them, or we might set up different materiality levels for those three items as well. So be with me. Now we are setting up materiality and taking steps. How do we need to do that? In the first case, we are taking up the financial statements as a whole using benchmarks, right? So the step one says the auditor needs to understand factors that may affect the identification of an appropriate benchmark. So you need to consider you are going to choose a benchmark, a criteria, right? So what factors you need to consider while choosing a benchmark? Identifying an appropriate benchmark. What benchmark is appropriate in a particular circumstance or situation? We are here at step one. We are identifying an appropriate benchmark for our audit to decide the level of materiality. Okay. So what could be the factors? Factor number one, the elements of financial statements. What could be the elements of financial statements? You can take up assets, liabilities, equity, revenue from the profit and loss, expenses from the profit and loss. You can take them as benchmarks. These are the elements of financial statements. Okay. So first factor could be this. Second, first factor is elements. Second factor, whether there are items on which the attention of the users of that particular entity's financial statements tends to be focused. So if there are some items in the financial statements which are specific to that particular industry, entity, so users might be giving attention to that particular item. For example, it could be profit, revenue, or net assets. Or for example, take the example of a construction industry, construction company. So users would be more interested in what new projects is the company taking up. What is the status of the previous projects? Has the company been able to complete those projects, or they are still lying uncompleted and the incompleted, and the company is taking up more and more projects? So it is expanding more and more. It is aggressive in taking up projects, but the revenue generation is at a lower pace. So this would attract the attention of the users of those financial statements of that particular company belonging to construction industry. Okay. Third factor, the nature of the entity. What kind of entity it is? The entity which you are auditing. In our case, it is a hotel where the entity is at in its life cycle and the industrial and economic environment in which the entity operates. So where is this particular entity? Is it a newly built company, or it is enjoying its vintage, its reputation of many years? Tata's. Where is it in its life cycle? Startups, new companies. And the industry and economic environment in which the entity operates. So in the times of COVID, whether this particular company is thrusting upon work from home, or it is the kind of company where work from home is not possible. Our hotel suffered a lot during the COVID lockdown, the economic environment. The entity's ownership structure, debt-oriented, equity-oriented, partnership firm, and the way it is financed. Okay, example, I would see if the entity is financed solely by debt rather than equity, users may put more emphasis on assets and claims on them than on entity's earnings. So earnings is an annual process, but the assets, the assets of the company belong to the shareholders, the equity, and the debt. The lenders have a charge on those assets in case the company fails to pay their amount. The assets will be sold to realize their amount if the profits are not enough. So in that case, the equity, the owners of the company would be more focused on building up assets rather than earnings, because in their case, the debt is more. The debt is more than their own capital. So this would be the benchmark, the net assets belonging to the company. This would be the benchmark in their case. The fourth factor is the relative volatility of the benchmark. Volatility. What benchmark have we chosen? With just a slight change in any of the factors, this particular benchmark jumps or downs. For example, with an increase in sales or with different variation in sales, our selling expenses differ. So we'd say selling expenses depend upon sales. So they're volatile as far as sales are concerned. So we should also consider the benchmark we choose should not be that much volatile, because then it will give different varied answers in different cases. So we have identified our appropriate benchmark. The step one, we are trying to find out materiality using our professional judgment for the financial statements as a whole. Step two, example. Now choose example. We have identified our benchmarks, whether we want to go elements of financial statements or specific items, or as per the nature of entity and how is it financed, or keeping in mind the relative volatility of the benchmark. Okay. So what could be the examples? Profit before tax. This could be an example, right? Profit before tax for continuing operations is often used for profit-oriented entities. The entities whose sole objective is profit making. Profit before tax is the most commonly chosen benchmark. You might have done in FM, EPS, higher profit making in costing. What is the higher profit making alternative available to you? Right? In that case, what could be chosen as a benchmark? Profit before tax. In those cases. Total revenue. When is total revenue taken? When profit before tax from continuing operations is volatile. Volatile with just a small change in the external factors. The profits may rise too high, it may fall too. So in that particular case, we cannot take profit as a benchmark in that particular situation. Then we have to take either gross profit or total revenue. For example, there could be a variation. The profit is volatile with respect to the indirect expenses. With respect to the indirect expenses. Okay, different entities realizing same gross profit differ on net profits. When we talk about industry, we talk about this industry, this particular business can give us this much of margin. इस business में इतना रुपया बच जाता है. When we talk about this, we are talking about margin, we are talking about the gross profits, because net profits are always released after we deduct indirect expenses from gross profit. And indirect expenses, what do you mean by indirect expenses? Which are within the control of the organization. Some might be having huge indirect expenses, some might be running the business on cost-effective manner, so they might be giving huge profits, the others might be giving low profits with the same GP. So profit is volatile with respect to indirect expenses, and then in that case, we'll consider their revenues or the gross profit. That is a comparable benchmark. Gross profit and total expenses and total equity or net asset value, as we done in the case of non-profit entities, where they are not concerned with the profit. Total equity or net asset value in our example, right, where an entity is solely financed solely by debt. So in that case, we said the equity is not concerned with profit, they are concerned with asset creation. So total equity or net asset value. How is their wealth increasing? Because debt, there is too much debt in the company. So their net worth should be increased and be brought to the level of the debt. Their stake in the company should increase. So in that case, we'll take up total equity or NAV as the benchmark. So we decided the factors for choosing the appropriate benchmark. Step 2, out of the factors, we choose a particular benchmark criteria. Now do we take the examples of those benchmarks? The third step, how to use that benchmark. So step 3 is, in relation to the chosen benchmark, relevant financial data. Now, how do we use the benchmark? We have chosen, for example, we have chosen profit. Now, how do we use the relevant financial data with respect to that benchmark? Prior period results, definitely. In my example, I compared turnover of prior period and selling expenses of prior period. The period to date financial results and financial position after the end of the previous year, I am auditing from 1st April of this particular current year till date. What is the trend? What is the status with respect to that particular benchmark profit? Is it uniform or just a little bit of the variation? Budgets or forecast for the current period. You have done the chapter of budgetary control in costing, where you forecast, you make master budgets. After 5 years, what is the condition after 2 years? What will be the situation after 3 years? So that is the budgets or forecast for the current and future period. We might have made budgets in the previous year for this current year. Next year, we expect that our turnover would be this. We would be making profits up to this percentage. Now you compare the forecast and actual position. Is there a difference? Adjusted for significant changes in the circumstances of the entity. While the audit you find that a particular entity has acquired another entity. For example, in our case, our client auditee, the hotel has acquired another hotel. Okay, and this has given them a big push in the hospitality industry in the area. So a merger or acquisition which is going to yield good results for them. This could be the financial data relevant for us with the benchmark. Take an example. When, as a starting point, the materiality for the financial statements as a whole is determined for a particular entity based on a percentage of profit before tax from continuing operations. So till now, as a starting point, we had taken profit before tax percentage, PBT percentage, from continuing operations as our benchmark to determine materiality. Circumstances that give rise to an exceptional decrease or increase in such profit may lead the auditor to conclude that the materiality for the financial statements as a whole is more appropriately determined using a normalized profit before tax from continuing operations figure based on past results. So there is some abnormal activity, extraordinary activity, which has affected the profits. So what does the auditor do? Auditor has chosen profit before tax to be used as a benchmark to determine materiality level. He identified the element profit. He took the example of profit. Now with respect to profit, he wants to set it as a benchmark, a percentage he wants to calculate. The percentage he would be calculating would define our materiality level. But due to some circumstances, there is an abnormal impact on those profits. The auditor would consider the prior year's data and work out a normal PBT percentage. For example, this year there was an incident of fire. In your accounting subject, you would have done the chapter of loss from insurance loss from stock and loss of profit. We adjust our financial items, trading account GP with respect to extraordinary items. This is what the case is. He'll use the financial data of previous years, prior years, to calculate a normalized profit before tax. So we identified the benchmark factor. We ticked the example to the chosen benchmark. We applied our financial data. Step 4. Now determine a percentage to be applied to a chosen benchmark to set up the materiality, to check the materiality. So there is a relationship between the percentage and the chosen benchmark such that a percentage applied to profit before tax from continuing operations will normally be higher than a percentage applied to total revenue. Let us understand with the help of example. Okay. The auditor may consider 5% of profit before tax from continuing operations to be appropriate for a profit-oriented entity in a manufacturing industry, while he may consider 1% of total revenue or total expenses to be appropriate for a not-for-profit entity as the materiality level. So he has set his materiality with respect to profit at 5%. If the profit before tax is 5%, he's happy. More than that. But if it is below that level, he needs to check what is the reason of such low profits. Are there any fake expenses booked? Or actually there was a situation which gave rise to such circumstances that entity realized low profits during this year. In the case of NPOs, where profits do not matter. He might consider 1% of total revenue or expenses to be appropriate as a benchmark for materiality level deciding. Okay. As far as the facts of the case are concerned, higher or lower percentages as deemed appropriate by the auditor, keeping in mind his professional judgment, may be considered appropriate. Exceptional circumstances, unusual circumstances. So we set up benchmark for the financial statements as a whole, right? Factors identified for benchmark, examples taken up, financial data analyzed, and then a percentage applied. And then our materiality level is set. Okay. Now, this was for financial statements as a whole. When you have to take up some individual account balances or classes of transactions or disclosures, in that case, how do you set up materiality amount? How do you set up the level of materiality? So, factors that may indicate the existence of one or more particular classes of transactions, account balances, or disclosures for which misstatements of lesser amounts and materiality for the financial statement as a whole could reasonably be expected. So you have set up a materiality level using benchmarks for the financial statements as a whole. But there could be a case where your classes of transactions or account balances or disclosures might require a materiality level less than the materiality level which you have set up for the financial statements as a whole. So which factors could give rise to such situation? What are those factors? The factors include whether law, regulations, or the applicable financial reporting framework affect users' expectation regarding the measurement or disclosure of certain items. In my company's case, 1% of the revenue or the 1% of the revenue or rupees 1 lakh, as we did in financial reporting framework example, right? That could not be the materiality level for me, but the law requires it. So in that case, like we did in the case of 5% shareholding, disclosure is required. There could be many shareholders, but the financial reporting framework, as an auditor, I might find it immaterial, but the financial reporting framework requires it. It finds the FRF finds it material. I have to abide by it. Law, regulations, and financial reporting framework with respect to that particular class of transactions, account balances, or disclosures. For the financial statements as a whole, it might not be required of me to disclose the equity shareholding more than 5%. There could be many shareholders who are holding more than 5% shareholding. So as far my professional judgment is concerned, I would say it is quite normal for this particular entity. There are many shareholders. Almost 95% shareholders are holding more than 5%. This is not possible. Actually, this is not possible. Okay. So there could be a situation. There could be a situation where this is quite normal for the organization. But the law requires it at the transaction level, at the account balance level, or at a disclosure level. The auditor has to abide by it, even if he has set up the materiality level above that limit for the financial statements as a whole. Next factor could be the key disclosures in relation to the industry in which the entity operates. For example, research and development costs for a pharmaceutical company. They could be less than the materiality level. They could be less than the materiality level which I have set up for the financial statements on a whole basis. But since pharmaceutical industry requires me to categorize separately research and development costs because they have a different accounting treatment as per my accounting standard, irrespective of the amount. So in this case, whatever materiality amount I have set up for the financial statements as a whole, doesn't matter for research and development cost, a particular class of transactions. Okay. Then when whether attention is focused on a particular aspect of the entity's business that is separately disclosed in the financial statement. For example, the company has acquired a new business. So when the hotel has acquired a new hotel, this transaction is something which is material, right? And we need to draw the attention of the stakeholders, the users of financial statements, to this fact, which needs to be disclosed. So these were the cases, these are the factors where the auditor might have to set up materiality levels below the materiality level, which has already been set up for the financial statements as a whole, when it comes down to a class of transactions or some account balances or disclosures. Right? I hope there is no more network issue. Is it fine now? Please refresh your page, your web page. Whenever you get network issue, please refresh your page. Okay. When do you require to revise your materiality levels? Situation 1. The auditor shall revise materiality for the financial statements as a whole. And if applicable, the materiality level or levels for particular classes of transaction, account balances or disclosures. In the event of becoming aware of information during the audit that would have caused the auditor to have determined a different amount or amounts initially. In my example, I set up the amount at 10,000, but during the audit, J came with more information. So we need to revise the materiality. See, I found so many of misstatements between the slab of 8,000 to 10,000. G was correct. I revised my materiality level from 10,000 to 8,000. This was an example where I became aware of information during the audit. Okay. Now, next part. Further, when I became aware of this information, okay. If the auditor concludes that a lower materiality for the financial statements as a whole, then the initially determined is appropriate. The auditor shall determine whether it is necessary to revise performance materiality and whether the nature, timing, and extent of further audit procedures remain appropriate or need to be designed again. So I have revised my materiality level. If my materiality level is revised, my performance materiality depended upon materiality. Because what was performance materiality? Performance materiality was my conservative approach that as far as the facts of the case are concerned, I have set up my materiality amount to this level. But I feel I should work with a materiality level below this amount which I have set. That became performance materiality. Performance materiality is subjective of the auditor. So when materiality is revised, obviously we need to consider the need to revise performance materiality. And further, do we need to revise our audit procedures as well? We need to expand the scope of our audit procedures. So when I become aware of an information, During the audit, I might have to revise my materiality level. If materiality level is revised, I might have to revise my performance materiality level as well. And when these materiality levels are revised, I need to reconsider whether I need to revise my audit procedures or further audit procedures as well or not. Okay, I'll come to that, Charu. I'll come to that. Reasons for revision in materiality, many reasons. Let's see some of reasons over here. As a result of change in circumstances that occurred during the audit. For example, the entity disposed of a major part of their business. The hotel, in our case, right? The hotel, in our case, they sold their fleet of vehicles. They are not giving pick and drop facility or taxis to the tourists. So major segment of their business, which they were earning from the hiring of taxis, pick and drop services, it would not be there from now onwards, the receipts and expenses. A new information, for example, I found a new information. The company has been fighting a case since long, and it is probable that the company might win this case or the company might lose this case. And how is it going to impact our financial statements? A change in the auditor's understanding of the entity and its operations as a result of performing further audit procedures. As and deep the auditor delves into the business of the entity, the books of the entity, he gets more and more info, more and more discoveries, observations, and he feels, no, the materiality levels I set, the audit procedures I designed during the planning stage, they need to be revised. I have to work a lot during the audit of this particular entity because I can see a lot of misstatements. So a change in understanding of the auditor's understanding of the entity. Example, if during the audit it appears to the auditor that the results, financial results, are likely to be different from the anticipated period end results. During the audit, he finds, suppose it's an interim audit, internal audit, and he finds that what we have anticipated at the end of this year, the company would be making this much of the profits, right? And based upon those forecasts, I set up my benchmark. I took them as benchmark and set up my materiality level, right? But I feel the profits are not going to work as per that benchmark. It could be different. So auditor will revise materiality levels. Estimations and current situation are going to differ. Auditor will revise the materiality level. So how we did revision in audit planning, revision in audit program, revision in materiality with reasons, they are all interconnected. Okay? You will find this in every standard on accounting. See, you have to conform to a certain set of rules and principles, which are called standards on auditing. And documentation is a very important part for any auditor with respect to any audit. So with every standard on auditing, you will find the part of documentation with respect to that standard. So with respect to SA320 materiality, with respect to materiality, what should the auditor document? What should be there in the auditor's documentation with respect to materiality? We discussed about documentation with respect to audit planning. We discussed about documentation with respect to audit program. Now we will discuss auditor's documentation with respect to materiality. So, what should be there in the auditor's documentation with respect to materiality? Materiality for the financial statements as a whole. What was his materiality level? It should be documented properly on what factors, benchmarks did he decide that yes, this is my materiality level. and what were the materiality levels as per the financial reporting framework. If applicable, if required, if he felt the need that he should define a different materiality for particular classes of transactions, account balances, or disclosures, so what was that materiality level? Then his performance materiality, and further, if there was any revision in the materiality at financial statements level, at materiality level, classes of transactions, or performance materiality, that should be, as the audit progressed, what was the revisions in the materiality. Okay. Just a second. I think I need to re-log in with the query session. So we complete our chapter over here. Whenever you find documentation, it is almost the last of any chapter. Okay, so we have some practice questions. Till the query session the web page is opening again. Let me take up with you the practice questions. First question: what could be considered material for all situations cannot be defined precisely, and an amount or transaction material in one situation may not be material in other situation. Explain. Okay. Fine. So what is the answer to this question? It says, what could be material for all situations may materiality differs from situation to situation. We did it over here. The part over here, this one, significance of materiality and differences in materiality. Here. Slide number 50, page number 50 and page number 45. Okay, next question. The auditor's determination of materiality. The auditor's determination of materiality is a matter of professional judgment and is affected by auditor's perception of the financial information needs of users of the financial statements. In this context, explain the auditor's assumptions about the users of financial statements. So what could the auditor expect of the users? This: have a reasonable knowledge of business, understand the financial statements are prepared, uncertainties, reasonable economic decisions. The answer to that particular question. Financial reporting frameworks often discuss the concept of materiality in the context of the preparation and presentation of financial statements. Explain. We discussed in detail about this financial reporting frameworks. Here we are. Slide number 47. What do they discuss? If they don't discuss, then what to do in that case? With examples. Then, planning an audit involves establishing the overall audit strategy for the engagement and developing an audit plan. Adequate planning benefits the audit of financials. This was a question from planning. Audit planning, we've already covered it. Okay. So, I hope everything is fine now. We'll take up the case study in 5 minutes. It will hardly take 5 minutes with the case study, right? So a case study based upon this chapter and questions. Please be assured I'll be giving you that case study with answers which I'm going to discuss over here in your notes so that you can practice it later on as well. Okay, so let me take that case study with you. let us first see a video on materiality. It's a very short video. I hope you can see the video. It's being shared.
Reality. An information is material if its omission or misstatement could affect users' decisions. Materiality depends on the size of the entity. The auditor establishes materiality level based on professional judgment. According to Securities and Exchange Commission, an item representing at least 5% of total assets is disclosed. Materiality concept is important in deciding whether a transaction should be recorded as part of the closing process in preparing financial statements.
Okay, let me take up the case study with you.
साल था 2015 में मैंने अपना पहला कोड लिखा था पेपर पर. 11वीं 12वीं में C++ लेनी पड़ी.
Okay. Fine, sir. I'll take up the case study first. Let me pick it up. Okay. I hope the file on the screen is visible to everyone. Yes, Brinda, I'll add the slide number with the question. Okay. So this is the particular case study from your chapter, Audit Strategy, Audit Planning, and Audit Program. Okay, so let us read this case study and solve the questions to follow. So I'll read it with you. I'll also give it to you. Messrs. Ch-2 and Associates is a chartered accountancy firm based in Mumbai. Right? The firm has been approached to conduct the statutory audit of a multinational company, Fiasco Global Limited, which is into the business of manufacturing and exporting fabrics. CA V. Kumar, who has just joined the firm as a new partner, is worried as to the management of key resources to be applied to conduct this audit, and thus he develops an overall audit strategy to set the scope, timing, and direction of the audit. Kumar, being the engagement partner for this audit, forms an engagement team for the audit, and coincidentally the whole team consists of new article trainees joining Ch-2 and Associates just recently. After planning the audit, Kumar constructs an audit program and delegates specific audit procedures among the engagement team members, keeping in mind the standards laid down as per SA 220. He asks them to revise the audit plan as per the need of the situation as the audit progresses, so that the audit objectives are not compromised. So as the audit progresses, the engagement team finds that the audit is not turning to be effective as planned, and thus worried as where the plan went wrong. X, one of the article trainees, after discussion with V. Kumar, came to a conclusion that following points were not taken care of before or while doing the audit. What were those points? Obtaining an understanding and knowledge of Fiasco Limited's business. Evolving and using the same audit program for all business is never practical. So they were using the same audit program for every kind of business. Previous year's audit and its findings were not taken into consideration while starting the audit. They didn't refer to the previous year's. Okay? Right? So this led to an ambiguity in identifying and assessing the risk of material misstatement. Okay? Hence, the engagement team decided to revise the audit plan and the audit program and carried out the following procedures. So what did the audit team do? They collected evidences for cash, investments pledged with banks and book debts, using net profit of 5% as the benchmark to establish materiality level and its relationship with audit risk. They documented each and every aspect of the audit, findings, issues faced, resolved, and observations as per SC 300. After completing the audit successfully and discussing all the findings and observations with the management of Fiasco Global Limited, CA Kumar prepared the statutory audit report and made all audit compliances effectively. Audit compliances as per standards on auditing. Right? So this was the story. This was the case of CA KT and Associates, CA B Kumar and Fiasco Global Limited. So let's come to the questions based upon this case study. The first question, the establishment of overall audit strategy and a detailed audit plan by CA V Kumar need to be discrete or sequential, discrete but need not be sequential, discrete and sequential. D, need not be discrete or sequential but closely interrelated. So what is your answer? Come on. What is your answer in this case? The establishment of overall audit strategy and a detailed audit plan by CA V Kumar need to be come up with the answers, please. We have to practice the case studies as well. Be well versed of the structure of your question paper and the kind of questions you will be asked. So what is your answer in this case? Question number 1. Question number 2. During the audit, CA Kumar and his engagement team came to know that a decision to dispose of a major part of the entity's business has been taken by the client company. So this is during the audit. Okay, people are answering. 1D, C, D, C, A, D. So many of the Ds are there. Need not be discrete or sequential, but closely interrelated. Some people are saying discrete and sequential. Let's see its answer. So first answer is yes. Audit strategy and audit plan need to be closely interrelated. They need not be discrete or sequential, as the strategy needs to be modified after revision in audit plan as the audit progresses. So the answer is D to the first question. Can you understand how the knowledge from this chapter has to be applied while answering the case study? So this is something which we have done today itself. During the audit, CA Kumar and his engagement team came to know that a decision to dispose of a major part of the entity's business has been taken by the client company. Then they should, what do? ignore as it is of capital nature, revise the materiality levels, withdraw from the engagement as materiality once decided cannot be revised. Do not apply SA 320 and qualify the audit report. Qualifying the audit report means giving a negative opinion or a different opinion than the normal one for time being. You'll understand the meaning of qualifying the audit report in the chapter of audit report. So what is the answer to question number 2? We have done it today only. For me, the answer could be B. Let us see what is the answer. We have done it today only. Revise the materiality level. Yes, answer is B. Because it is a major transaction which may affect the anticipated period and financial results that were used initially to determine materiality for the financial statements as a whole. So the answer is B. They need to revise the materiality levels just because of this information which they were made aware of during the audit. They should revise the materiality levels. Third part, this particular X is like Mr. J, who was with me during the whole audit. X, the article trainee, asked his principal C.A.V. Kumar if he could discuss the nature, timing and extent of their audit procedures with the management of Fiasco Global Limited before starting the audit. This may lead to A, an effective audit, B, fast and early completion of audit, C, compromise with the effectiveness of the audit, D, effective participation from the client staff in audit. So what is your answer to 3? Second question, many of you answered correctly. What is your answer to the question 3? Jay wants to discuss his nature, timing and extent of audit procedures with the management of Fiasco Global Limited. So it would result into an effective audit, early completion of audit, or it would compromise the effectiveness audit, or effective participation from the client staff in audit as required. Yes, please. Okay, many people say 3A, 3C, C. Confusion between A and C. What I feel, we did it on the first session for this chapter. For me, the answer could be C. Let's see. Yes. Discussing the nature and timing of detailed audit procedures with management may compromise the effectiveness of the audit by making the audit procedures too predictable. We did it on the first day. Let's come to question number 4. During the audit, X finds that Fiasco Global Limited is financed solely by debt rather equity. In such a case, the users of financial statements may put more emphasis on, this is something which we have done today itself. This should be answered correctly by everyone. Entities earnings, entities goodwill, entities assets and claims on them, entities business nature. Fourth, so the entity is financed solely by debt rather than equity. In such a case, the user of financial statements may put more emphasis on earnings, goodwill, assets and the claims on them, or the business nature. We have done this example today only while studying benchmarks. So for me, the answer could be C, entities, assets and claims on them. Let me see if I am right or not. Okay, the entity's earnings, no, the answer is wrong over here. During the audit, X finds out that Fiasco Global Limited is financed solely by debt rather equity. In such a case, the users of, oh yes. In such a case, the user of financial statement may put more emphasis on, it should be C, entities, assets and claims on them. It is C. It has to be C. We have done it today only. I'll correct it before uploading for you. I'll correct it. The answer is C. Okay? Fine. Let's come to the answer is C. I'll correct it. It should be entities, assets and claims on them. We have done it today itself. Fifth, this is the question which I feel everybody should answer quite appropriately correct. The best evidence that can be obtained to verify the cash balance by CA V. Kumar and his team in the given situation would be what it could be: cash ledger, cashier certificate, count, or bank reconciliation statement. To verify the cash, we did it in the last session. The best audit evidence to verify the cash balance. Please come up with the answers. I want everyone to answer this correctly at least. Although many of you are answering all the questions correctly, this particular question, to verify cash, my answer is C. It is C. Counting cash physically is the best audit evidence. So for fifth, my answer is C. Sixth, the nature, timing, and extent of further audit procedures at the assertion level need to be determined by CA V. Kumar and his team as per for further audit procedures. Cash wala question almost everyone has answered correctly. Good. So the nature, timing, and extent of planned further audit procedures at the assertion level need to be determined by CA V. Kumar and his team as per SA 300 planning, SA 315 knowledge, SA 320 materiality, SA 330. Let us see. What does it say? I suppose it should be A. Let's see what is the answer. What do you all say? Sixth answer. D. The auditor shall develop an audit plan that shall include a description of the nature, timing, and extent of planned further audit at the session level as determined under SA 330. Auditor's response to the assessed responses to the identified assessed risks, right? SA 330. Auditor's response to the assessed risks, further audit procedures. Oh, many of you answered correctly, right? Good, Harsh. Sneha, good, really good. Sixth was a typical question. Mind-boggling question. Sixth was like, you clearly have to understand what is an essay all about, because in particular situation, you have to apply all the essays. But what does a particular essay tell us about? What is its objective? You quite clearly need to remember that, because in these kinds of questions, there is confusion whether it is 300, 315, 320, 330. Nice, Dorji, good. Abhijit, Amrita, Abhijit, good. If you have answered 6th question correctly, it is really nice. Last question. The audit team in the above case established net profit of 5% as the benchmark to establish materiality levels and its relationship with audit risk. Such exercise involves professional skepticism, professional judgment, independence, knowledge of various laws. And this is the easiest question you could get. Easiest question. 7th answer. Sneha has already given that answer. 7th answer is B. Professional judgment. This was the most talked about word today. Professional judgment. Yes, Sonu, you have to remember the essay number as well as what does this essay tell us about. It is required of you. Good, nice. Everyone has answered 7th question correctly. So that was it. As far as your chapter 2 was concerned, audit strategy, planning and program. So we'll be giving you the notes of the whole chapter at one place. I uploaded it in parts, but now I'll upload the whole chapter with this case study and its answers at the end of that those particular notes, and I'll upload it for you. Please find it from there and practice. Read, learn, revise, and practice your chapter 2 thoroughly. Okay? Thank you so much. And if you still have any doubts, I can see if there are doubts, it's completely fine. Otherwise, we may wind up for today. I'll wait for 1 minute if there are any doubts. Otherwise, we can wind up. Yeah, yes, sir. Yes, Raj.